Thank you for listening to the Real Estate Voice podcast. This is Vernon R.E. Jones, managing broker, owner of Jones Homes. And for over 30 years, we have serviced the 7-county Denver metro area. Well, this is our first podcast of 2024, and I guess the most pressing thing I hear right now, and I get asked often, how low are mortgage rates going to drop? Well, basically, home buyers received an unexpected gift around the holidays as mortgage rates dropped rapidly late last year. They fell from about a peak of about 8% in the fall to the mid 6% range in late December. That's 1.5%, give or take. Many economists and forecasters hadn't anticipated that until the end of 2024, if they were being optimistic. Now, with the Federal Reserve Board poised to cut its own rates this year, the question on the minds of many aspiring home buyers and home sellers who are waiting on the market, waiting for rates to go down as well, how low will they drop? Most experts believe rates will stay in the 6% range this year, but some believe rates could slip into the 5% range by year's end. The Federal Reserve Board is anticipating, let's just put it this way. Experts are predicting the Federal Reserve Board might have 3 to 6 rate cuts this year. Now, how those will affect the mortgage market is still basically left out in the dark at this point. But if they are actually that aggressive, I will tell you normally that does involve a decrease in long-term interest rates. Let me reiterate again that usually when the Federal Reserve Board deals with interest rates, they're for short-term rates. But they do extrapolate over into long-term mortgage interest rates. Basically, the direction we're headed is down this year. Higher mortgage rates had effectively frozen the housing market last year. But they fell in mid-December after the Fed indicated that its campaign of raising interest rates to tame inflation was over. And I've already mentioned the predictive interest rate cuts that the Fed could do over the course of the next year. Again, predicted 3 to 6, and they're probably going to be 0.25 percentage point, or some even said 1/8 percentage point. And again, let me reiterate, that does not mean there's going to be 6 mortgage interest rate cuts of 0.25% that would take them down significantly. Again, they are influenced by the short-term rates, but they are not indicative of what they are. Mortgage rates are separate but directly influenced by the Fed short-term rates. As I just said, we expect a gradual reduction in mortgage rates, but it's going to play out in fits and starts. We might see a slight increase because I think over the last 30 days, I think it went up to from 6.5 to 6.9-ish range. But like I say, it's very vacillating. It's a very fluid situation right now. The average rate, 6.75 for 30-year fixed rate home loans on Friday, up from a low of 6.61 in late December. This is according to the Mortgage Bankers Association. The rise is a result of new unemployment data last week that shows the economy is stronger than the Fed would prefer as it continues to fight inflation. I think if you look at the economic labor market numbers, they were predicting maybe 160 to 180,000 jobs, and I think the jobs were over 210,000. Many investors expected the Fed to begin slashing its rates as early as March, which would likely have resulted in mortgage rates falling, but the Fed might keep rates higher for longer as it considers the strong jobs data along with how much inflation is coming down. Remember, as always, job data and the housing market go together along with interest rates. The more the economy cools, the quicker the Fed could cut rates. Well, how low will they go? Well, most experts are divided on just how much mortgage rates would fall. Most expect they will stay in the 6% range. I believe, based on the cooling of the labor market, they could potentially go to 6, maybe 5.75, and that's throughout the year. There's every reason to believe that if we continue to move in the right direction, unless there's something that comes out of nowhere, which has been the story of the last couple of years. Some things have come out of nowhere, wars and inflation and things of that nature, supply chains and all that kind of stuff. A rate in the 5% range could provide buyers struggling with the worst housing affordability in decades. With substantial savings, buyers who purchase a home with a 5.5% mortgage would pay about $216 less a month for their mortgage than those who locked in a 6.5 rate. And they would roughly save $442 a month compared with buyers at a 7.5% rate. This, of course, is assuming buyers are putting 20% down on a $420,000 home. However, the days of the 2 and 3% rates offered during the COVID-19 pandemic are not likely to return. To be honest with you, I don't think we will ever see those levels again, at least in the next 5 years. The Fed will reduce its rates by enough to bring mortgage rates down to those lows unless the U.S. economy was in dire straits. In other words, it almost have to be an economic recession and much less an economic collapse. If we ended up back there, we'd be in a very bad recession. Lower mortgage rates are already having an impact on the housing market. When rates went down at the end of last year, most mortgage bankers saw first-time homebuyers get pre-approved for loans at a higher rate. Even more encouraging were the conversations we all began having about homeowners about how they would consider selling and moving into new homes when rates went down into the 5% range. That's a survey that was done that it's kind of like, what does the rate needs to be for sellers to get off of the fence who want to buy something else, and what would motivate them? And it seems like 5% may be the rate that would motivate sellers who are waiting to put their homes on the market to buy something else. 2 years ago, mortgage rates in the mid 6.5% would have scared off or priced out many would-be buyers. But now, though, buyers have had time to get used to them. They may even seem like a bargain compared with the roughly 8% rate seen in October. However, reduced rates might be a double-edged sword as more would-be buyers would enter the market. The nation is still struggling with an extreme housing shortage. Additional competition for a limited number of homes could usher in the return of bidding wars and push home prices higher. However, the homeowner who is interested in selling and moving into buying another market, it appears under that 6%, that between 5 and 6% rate, is the panacea, maybe the answer that motivates them to do so. But the housing market's not going to go crazy. It's not going to be as active as it was or as frenzied as it was when rates were at record lows in the 2020 and 2021 period. But I will say this to you. Keep in touch. If you have any questions, you can call me directly at 303-359-8218, because not all situations are the same, and your personal situation may always be different. Thank you for listening to the Real Estate Voice Podcast. This is Vernon R.E. Jones with Jones Homes. Thank you for listening, and as always, please be safe.